There's a chart that every serious investor needs to see right now. It is one of the most violent price movements in the history of precious metals, a vertical line shooting straight up on Thursday, January 29th, followed by an almost identical line falling straight back down on Friday, January 30th. Silver went from an all-time high above $121 per ounce to the low 70s in less than 24 hours. That is not a correction. That is not a pullback. That is one of the sharpest single-day collapses this metal has ever experienced. And what is remarkable is not just how fast it happened, it is that almost everyone who was paying close attention could see the warning signs if they knew where to look. This is the story of what actually happened, why it happened, and what the next chapter looks like for one of the most volatile assets on the planet. Welcome back to Chart Chamber, where we break down the forces moving global markets so you can understand what is really going on behind the headlines. Today we are going to walk through this event in detail, not to frighten you, and certainly not to tell you what to do with your money, but because this moment reveals something important about how commodity markets actually work, how exchanges control the pace of speculation, and why the pattern we just watched unfold has played out almost exactly the same way at least 2 other times in the last 45 years. To understand what happened this week, you first need to understand what was happening in the weeks and months before it. Silver did not arrive at $121 per ounce out of nowhere. This was the culmination of one of the most sustained and powerful rallies this metal has seen in modern history. Through 2025, silver surged roughly 135% for the full year. Then, in January of 2026 alone, the metal added another 50 to 60% on top of that parabolic climb. By the time silver touched its record high on Thursday evening, it had risen somewhere around 300% from where it was trading just 12 months earlier. That kind of move does not happen because of a single headline or a single investor. It happens when multiple powerful forces converge at the same time, and in this case, there were at least 3 distinct engines driving the rally simultaneously. The first engine was structural, and it is the one that most casual observers tend to overlook. The global silver market has been running in a supply deficit for 5 consecutive years. What that means in plain terms is that the world has been consuming more silver than it has been producing every single year since 2021. The Silver Institute, which is one of the most respected research bodies covering this market, estimated that the cumulative deficit over that 5-year stretch reached approximately 820 million ounces. To put that into perspective, that is roughly an entire year of global mine production that simply was not there to meet demand. And the reason supply has struggled to keep pace is not complicated. About 70% of the silver that gets mined each year does not come from silver-specific mines at all. It comes as a byproduct while mining copper, zinc, or gold. So even when silver prices surge, mining companies cannot simply ramp up production overnight. They are largely bound by the economics of those other metals. Mine output stayed relatively flat at around 813 million ounces annually throughout this period, while demand kept climbing. The demand side of that equation is driven largely by industrial consumption, and the biggest single driver over the past several years has been solar energy. Silver is the most electrically conductive metal on Earth at room temperature, which makes it an essential ingredient in photovoltaic panels. Solar installations have been hitting record highs year after year, and the share of global silver demand consumed by the solar sector grew from roughly 11% back in 2014 to nearly 30% by 2024. On top of that, electric vehicles, AI data center infrastructure, and general electrification trends have all added significant layers of demand that did not exist a decade ago. Industrial use now accounts for roughly 59% of total silver consumption worldwide, up from about 50% just 10 years ago. This is not speculative demand. This is physical metal going into products that the global economy needs to build. The second engine driving the rally was macroeconomic and geopolitical. Throughout 2025 and into early 2026, there was a pervasive and growing concern among investors about the long-term trajectory of the US dollar. When central banks around the world, particularly in BRICS nations, began aggressively diversifying their reserves away from dollar-denominated assets, precious metals became one of the primary beneficiaries. Gold surged past $5,000 per ounce during this same window, but silver, being a smaller and more volatile market, tends to amplify those moves. Investors who wanted exposure to the safe haven trade but could not afford gold at $5,000 per ounce found silver to be an accessible alternative. The metal crossed $100 per ounce for the first time in history during January, and capital flooded in from both institutional and retail participants. Additionally, in November of 2025, the United States formally designated silver as a critical mineral, which further reinforced its strategic importance and encouraged accumulation. The third engine was leverage, and this is the one that ultimately set the stage for the crash. As silver prices climbed higher and faster, more and more traders began using futures contracts and leveraged positions to participate in the rally. This is how commodity futures markets work. When you trade a silver futures contract on the COMEX or CME exchange, you do not need to put up the full value of the contract. You put up a fraction of it, called a margin, and the exchange essentially lets you control a much larger position than your cash would otherwise allow. A single standard silver futures contract represents 5,000 ounces of silver. At $120 per ounce, that contract is worth $600,000, but a trader might only need to post $30,000 or $40,000 in margin to hold that position. The rest is borrowed, in effect. That leverage amplifies gains enormously on the way up. But it also creates a structural vulnerability, because if prices move against you, the exchange can force you to sell, regardless of whether you want to or not. By late January, the silver futures market was extraordinarily crowded. Hope and interest was elevated, speculative positioning was stretched, and according to technical analysts, the relative strength index for silver had been deeply overbought for days. Multiple indicators were flashing that the market had moved too far, too fast. But as long as buyers kept showing up, the price kept climbing. That is how momentum-driven markets work in their final stages. The indicators scream caution, and the price keeps going up until it does not. Now, let us talk about what actually happened on Thursday and Friday. On Thursday, January 29th, silver touched an intraday high of approximately $121.78 per ounce, an all-time record. The market was still elevated and relatively calm at that point. Traders who had been riding the rally were sitting on enormous paper gains, and the general mood in precious metals forums and trading channels was one of euphoria. Then, on the morning of Friday, January 30th, President Donald Trump announced his intention to nominate Kevin Warsh as the next chair of the Federal Reserve. To understand why that single piece of news had such an outsized effect on precious metals, you need to understand what had been driving the safe haven trade in gold and silver for the preceding months. A significant portion of the rally was built on the narrative that the Federal Reserve's independence was under threat, that the next Fed chair might be someone who would simply do whatever the president told them to do, which in this case meant cutting interest rates aggressively and keeping them low indefinitely. A Fed chair who would do that would essentially be green light to print money, which historically weakens the dollar and drives investors toward gold and silver as alternative stores of value. Kevin Warsh is not that person. Warsh is a former Federal Reserve governor who served during the 2008 financial crisis. He has deep institutional knowledge of the central bank, strong credibility with Wall Street, and a reputation earned over years as a monetary hawk. During his previous tenure on the Fed board, he generally opposed using aggressive rate cuts to stimulate economic growth. Markets interpreted his nomination as a signal that the Fed's independence would be preserved, that the era of unchecked dollar debasement fears might be coming to an end, and that interest rates might stay higher for longer than the most dovish scenarios had assumed. The dollar index immediately began to strengthen. And when the dollar strengthens, precious metals, which are priced in dollars and do not pay any interest, become less attractive to hold, particularly for foreign investors. That initial reaction was sharp. Within the first few hours of trading on Friday morning, silver dropped 10 to 15%. But what happened next was not simply a market repricing based on the Warsh news. It was a cascade, a chain reaction triggered by the mechanics of leveraged trading that turned a significant correction into a historic collapse. Here is how that cascade works, and this is the part of the story that most headlines skip over entirely. When silver prices began falling on Friday morning, traders who held leveraged long positions, meaning they had borrowed to bet that silver would go up, started seeing their margin accounts shrink. In a futures market, your broker monitors your account in real time. If your account balance falls below a certain threshold, called the maintenance margin, the broker issues what is known as a margin call. That margin call gives you a very short window to either deposit more cash into your account or sell some of your positions to bring your balance back above the required level. If you do not act quickly enough, the broker sells your positions for you automatically, whether you want them to sell or not. Now imagine that happening across thousands of accounts simultaneously. Every forced sale adds more downward pressure to the price, and every additional price drop triggers more margin calls across even more accounts. This is what market professionals refer to as a liquidation cascade, and it is one of the most destructive and self-reinforcing dynamics in all of financial markets. The selling feeds on itself. Each wave of forced liquidation pushes prices lower, which creates the next wave of margin calls, which creates the next wave of forced selling. On Friday, January 30th, that cascade unfolded with extraordinary speed. Silver futures plummeted 31.4% to settle at $78.53, marking the worst single day for silver since March of 1980. Spot silver traded as low as $74.60 intraday, representing a decline of more than 35% from the Thursday high. The iShares Silver Trust ETF, one of the largest and most liquid silver funds in the world, fell over 30% in a single session. The leveraged ProShares Ultra Silver Fund dropped more than 60%. These were the worst single-day performances on record for both funds. The entire precious metals complex was hit. Gold fell roughly 9 to 11%. Platinum and palladium also collapsed. The selling pressure rippled into cryptocurrency markets as well, with Bitcoin falling in tandem as investors scrambled for liquidity across asset classes. But the liquidation cascade did not happen in a vacuum. It was intensified, and arguably accelerated, by something the CME Group did in the days immediately surrounding this event. And this is where the story gets particularly interesting, because it connects directly to a pattern that has repeated itself at least twice before in the history of silver. The CME Group is the exchange operator that runs the COMEX, which is the world's largest silver futures market. Throughout January 2026, as silver prices were climbing toward their record high, the CME had already begun raising margin requirements on silver futures contracts. Earlier in the month, the exchange shifted from a traditional fixed dollar margin system to a percentage-based model, which meant that as silver prices rose, the amount of collateral traders were required to post automatically increased in lockstep. Initial margins for silver were set at approximately 9.9% of the contract value, a level that represented a significant increase from previous requirements. Then, on Friday, January 30th, the same day the crash was unfolding, the CME announced a second round of margin increases, this time raising maintenance margins by 36% for silver futures. This was set to take effect on Monday, February 2nd. The message was clear. The exchange was telling the market, if you want to hold leveraged silver positions going forward, you need to put up substantially more cash. For traders who were already watching their accounts bleed red on Friday, the knowledge that even higher margin requirements were coming on Monday made the decision to hold even more difficult. Many chose to exit entirely rather than face another potential margin call at the start of the following week. This brings us to the historical pattern, because what happened in January 2026 did not occur in isolation. It echoed, almost structurally, what happened in two previous silver episodes, and understanding those comparisons is essential to understanding where silver goes from here. The first comparison is 1980 and the Hunt brothers. Nelson Bunker Hunt and William Herbert Hunt were Texas oil billionaires who spent years accumulating silver, both physical metal and futures contracts, on a massive scale. By late 1979, they and their associates were estimated to hold somewhere around 1/3 of the world's tradable silver supply. Silver prices exploded from roughly $6 per ounce in early 1979 to nearly $50 per ounce by January of 1980, a move of over 700% in roughly 12 months. The Hunt brothers used enormous leverage to sustain and amplify their position, borrowing heavily against their silver holdings to buy even more. Regulators took notice. On January 7, 1980, the COMEX implemented what became known as Silver Rule 7. This rule dramatically restricted speculative silver purchases on margin and effectively prohibited most new leverage buying. If traders wanted to continue acquiring silver after that point, they essentially had to pay full cash. The Hunt brothers, who had built their entire position on borrowed money, suddenly found themselves unable to sustain it. Prices began to fall, margin calls started arriving. And on March 27, 1980, a day that became known as Silver Thursday, the price of silver collapsed from around $15 to $10.80 in a single session. Over the following weeks and months, silver continued falling, eventually dropping below $5 per ounce by 1982. The Hunt brothers defaulted on a $100 million margin call, were bailed out by a consortium of banks with a $1.1 billion credit line, and ultimately lost the vast majority of their fortune. The second comparison is 2011. In that episode, silver rallied from around $9 per ounce in 2009 to nearly $50 per ounce by late April 2011, driven by a combination of quantitative easing by the Federal Reserve, speculative enthusiasm, and safe haven demand. The CME responded in precisely the same way it would respond in 2026. Between April 26th and May 9th of 2011, the exchange raised silver margin requirements 5 separate times in just 9 days. The cumulative effect was an increase of approximately 84% in the cost of holding a leveraged silver position. Open interest in silver futures dropped roughly 15% during that window as traders exited. Silver prices fell by 30% within weeks of those margin hikes and ultimately entered a bear market that lasted the better part of 9 years. Now, the question that naturally arises when you lay these 3 episodes side by side is whether they are actually the same story, or whether 2026 is fundamentally different. And the honest answer is that it is both. The mechanism is identical. Every time silver goes parabolic, meaning it shoots up at an unsustainable vertical angle, the CME raises margins, forced liquidation follows, and prices reverse sharply. That pattern is not a coincidence. It is the predictable result of how leveraged futures markets are designed to function. Exchanges exist to manage risk, and when leverage becomes dangerously concentrated, exchanges have both the authority and the obligation to act. Whether you view that as responsible regulation or as an intervention that favors certain market participants over others is a matter of perspective, but the mechanism itself is well established and entirely legal. What makes 2026 different from 1980 and 2011, however, is the underlying fundamental story. In 1980, the silver rally was primarily driven by two billionaires hoarding metal and by a broader flight from the dollar during a period of stagflation. Once the speculative mania broke, there was no structural reason for silver to hold elevated prices, and it did not. In 2011, the rally was fueled largely by the Federal Reserve's quantitative easing programs, which flooded the financial system with liquidity and weakened the dollar. When QE2 ended in June of that year, one of the primary catalysts for the rally simply disappeared, and silver had no fundamental floor to catch it. In 2026, the situation is materially different. The supply deficit is real and structural. Industrial demand from solar, electric vehicles, AI infrastructure, and electrification is not speculative. It is physical metal going into products. The global silver market has been in deficit for 5 consecutive years, accumulating a shortfall of over 800 million ounces. Mine production cannot respond quickly because most silver is a byproduct of other metals mining. China tightened its silver export controls at the start of 2026, further restricting global supply flows. The United States designated silver as a critical mineral. These are not narrative-driven dynamics. They are supply chain realities. This is why many analysts and strategists are drawing a sharp distinction between the speculative layer of the silver market, the leveraged futures positions, the momentum traders, the retail participants chasing price action, and the fundamental layer, which is the physical supply and demand picture. The crash on January 30th primarily destroyed the speculative layer. Leveraged positions were liquidated en masse. Retail traders who had bought silver futures or leveraged ETFs near the highs suffered devastating losses. But the physical silver market, the solar panels being installed, the electric vehicles being manufactured, the data centers being built, did not change at all on Friday. The demand for physical silver did not disappear because a futures contract settled at $78 instead of $120. This distinction is critical for understanding what happens next, and it is where the 3 possible scenarios diverge. The first scenario is that this correction is healthy and temporary, that it represents a violent but ultimately normal deleveraging event within a larger bull market. This is the view held by analysts who point to the structural deficit, the inelastic industrial demand, and the historical precedent of silver recovering after margin-driven pullbacks. Under this reading, the market simply needed to flush out the weakest hands and the most irresponsible leverage before the next leg higher could begin on a more sustainable footing. Physical silver demand remains robust, the deficit persists, and eventually the price will need to reflect that reality. The second scenario is that silver has reached an interim top, that it will consolidate sideways for an extended period, grinding between roughly $70 and $90 as the market digests the losses from the crash and institutional participants reassess their positioning. This is not a collapse scenario, it is a cooling off period. Under this view, silver remains fundamentally supported but will not make new highs for months, possibly longer, as the market rebuilds a healthier base of participants who are less reliant on leverage. The third scenario is more bearish. It suggests that the parabolic move to $121 was, at least in part, a speculative bubble, that a meaningful portion of the rally was driven by momentum, retail enthusiasm, and narrative rather than fundamentals alone, and that the correction could continue deeper before stabilizing. Former JP Morgan chief strategist Marko Kolanovic made headlines this week by warning that silver could ultimately trade at roughly half its recent highs, around $50 per ounce, if the speculative excess fully unwinds. This is not an unreasonable position historically. Silver has experienced 50% or greater drawdowns after parabolic rallies before, and the sheer speed and magnitude of the move into $120 suggests that at least some fraction of the buying was disconnected from fundamentals. So which scenario is correct? The honest answer is that no one knows with certainty. But there are specific levels and indicators that the market will use to resolve that question in the coming weeks. If silver stabilizes and begins to hold support in the $80 to $90 range, which represents a significant correction from the highs, but still well above where the metal was trading for most of 2025, that would be a constructive sign that the bull market structure remains intact. The physical demand story has not changed, and buyers who were priced out at $120 may view prices in the 80s as a more rational entry point. On the other hand, if selling pressure continues and silver breaks decisively below $70, that would signal a more serious reversal, one that suggests the speculative unwinding has deeper to go before the market finds a floor. The 200-day exponential moving average, which currently sits around $55, represents what many technical analysts consider the ultimate line in the sand for the longer-term bull case. There's one more dimension to this story that deserves attention, and it is the broader question of what Friday's events reveal about how commodity markets function and who benefits when exchanges intervene. The CME Group is not a neutral party in this process. It is a publicly traded company, and its business model depends on trading volume and the fees associated with it. Margin hikes reduce speculative activity, which can temporarily reduce the exchange's revenue, but they also protect the clearinghouse, the entity that guarantees the other side of every futures trade, from the kind of systemic risk that emerges when leverage becomes dangerously concentrated. The CME has consistently stated that its margin adjustments are driven by risk management, not by any desire to manipulate prices in either direction. And for the most part, that explanation holds up. The exchange did the same thing in 2011 and in 1980, and in both cases, the intervention was followed by significant price declines. But the exchange also did the right thing from a systemic perspective. An uncontrolled silver squeeze could have destabilized brokerages, triggered counterparty failures, and created contagion across financial markets far beyond the precious metals sector. What is worth noting, however, is who bears the cost of these interventions and who benefits. Retail traders using leverage, the smallest and least sophisticated participants in the market, are almost always the ones who get liquidated first and lose the most. Large institutional players with deep balance sheets and the ability to post additional margin often survive these events and can even profit from the dislocations they create. This asymmetry is not unique to silver. It exists in virtually every leveraged market, but it is particularly visible in precious metals, where retail participation has surged over the past year and where the gap between the speculators and the institutions is especially wide. As we look ahead, the most important thing to watch is not the day-to-day price action, which is likely to remain extremely volatile for weeks, but rather the behavior of the physical market. Our inventories on the COMEX and in London continuing to draw down, our industrial buyers, the solar manufacturers, the EV producers, the electronics companies, still consuming silver at the same rate? Is the structural deficit persisting? If the answers to those questions remain yes, then regardless of what happens to the speculative layer in the short term, the fundamental case for silver over the medium and long term has not been invalidated by Friday's crash. It has simply been temporarily obscured by it. The history of silver teaches us that the metal does not move in straight lines. The 1970s saw gold surge from $40 to $200, then crash 50%, and then eventually reach $800 by the end of the decade. The investors who understood the difference between a healthy correction and a permanent reversal, and who had the patience to hold through the pain, were ultimately vindicated. Whether 2026 follows that template or whether it follows the more cautionary path of 1980 and 2011 will depend on whether the structural fundamentals hold. That is the question worth watching. If you found this breakdown valuable, and if understanding these kinds of market mechanics matters to you, then make sure you hit that like button and subscribe to Chart Chamber. We cover these stories in depth every single time they matter, and there is a lot more happening in global markets right now that deserves this kind of attention. We will see you in the next one.